1909. A man whose name survives only in a single ledger entry earned $24 a year clearing timber in the Blue Ridge. His rent was $6. The rest went into a burlap sack nailed to a floorboard in the smokehouse. He had no bank account, no credit, no debt. And when the textile market froze in 1914, he did not lose a single cent. If you have ever opened your bank statement to find a maintenance fee, an overdraft fee, a transfer fee, a paper statement fee, and a fee for the privilege of being charged fees, you already know the slow dread of a system designed to extract rather than protect. The average American household now pays over $200 a year in bank fees alone. That is before inflation, before overdraft penalties, before the creeping realization that every transaction costs you something the bank never names. What you are about to read is not a collection of curiosities. It is a recovered code. 20 techniques that worked before the banking system became a toll road. Every single one of them is still legal. Most of them are still possible. None of them require you to trust an institution that profits from your confusion. That first ledger entry is a witness to something you may not have considered yet. It is not a story about a poor man. It is evidence of a functioning system that did not require a bank. If this is the first time you have seen a financial tool that works without an institution, subscribe so you do not miss the specific ledger excerpts and archival documents I will share as we go deeper. And when you do, tell me in the comments, what did you have to unlearn about money to realize that a burlap sack was a more reliable savings tool than a checking account? The first trick is the oldest. You do not need money to acquire what you need. Barter predates coin by roughly 5,000 years. A 1947 record from the Banco Central do Brasil documents a cattle exchange in the state of Minas Gerais, where two families moved 20 head of cattle without a single copper coin changing hands. The clerk wrote it down because he had never seen it done so cleanly. The transaction was recorded, reported, and taxed at the value of the meat and hide. The families paid nothing to any bank. You have done this without knowing it. You helped a neighbor move furniture. Your neighbor fixed your truck. Neither of you reported it because neither of you thought of it as income. That is the second trick. Barter income is taxable, but only if you treat it as income. The IRS issues Form 1099-B for exchanges made through organized barter networks. If you trade a repaired fence for a cord of firewood with the man next door, no form exists. The system only tracks what it can see. Here is where most people stop. They assume barter requires a coincidence of wants. The roofer needs dental work, and the dentist needs a roof. That is the third trick. You do not need a direct match. You use a ledger. In rural Pennsylvania in the 1920s, farming families kept what they called a book of obligations. You roofed a neighbor's barn. He recorded it. A year later, you needed a well dug. He knew a man who owed him for a hay delivery. The well was dug. No money moved. The ledger tracked the chain. The fourth trick is the simplest container you will ever use: a tin can. Before the Federal Reserve standardized currency, families stored their savings in metal containers buried in the dirt floor of the smokehouse or the root cellar. In 1932, a Kansas farmer named Arthur Pemberton dug up a can he had buried in 1919. Inside was $143 in silver coins. The bank that held his neighbor's deposits had failed 6 months earlier. The neighbor had nothing. Pemberton bought a new plow with the same coins he had saved 13 years prior. The fifth trick is the land contract. Before mortgages became the default, families bought land directly from the seller with a promissory note and a handshake. The deed was recorded at the county courthouse. The bank was never involved. A 1928 study from the United States Department of Agriculture found that over 40% of farm purchases in the Midwest were financed through seller financing. The interest rate was typically 0. The terms were written in a single page. The bank had no leverage because the bank was not part of the transaction. The sixth trick is the cooperative. In the 1910s, Dairy farmers in Wisconsin formed a barter circle. Each member contributed a percentage of their milk to a central pool. The pool was used to pay a doctor, a teacher, a blacksmith. No cash ever left the community. The doctor received milk credits. The blacksmith received cheese credits. The system survived the panic of 1914 because it did not depend on banknotes that could be called in overnight. A 1915 report from the University of Wisconsin documented over 200 such cooperatives in the state. Every one of them was still operating when the report was published. The seventh trick is the most elegant. You never borrow from a bank. You borrow from yourself. In 1920s Arkansas, a sharecropper named Silas Bowen saved $1 a week for 3 years in a crack in his cabin wall. When the cotton market collapsed, he used that money to buy seed on his own terms. He owed nothing to the plantation store. The store charged interest of 30%. Bowen paid 0%. He owned the money. The bank never touched it. The eighth trick is something you already own: your skill. A carpenter in 1910's Ohio named Ezra Milligan traded a single week of labor for a year of his son's schooling. He built a schoolhouse roof. The teacher accepted the work as tuition. No check was written. No loan was taken. The teacher needed a roof. Milligan needed education. The exchange was recorded in a single sentence in a diary. That diary is now in the archives of the Ohio Historical Society. The total value of the transaction was $75 in labor. The interest that would have been charged on a loan for the same amount was 0. The ninth trick is the one the banks fear most: promissory notes, a written promise to pay a specific amount at a specific time. In the 1800s, promissory notes were as common as cash. They were used to buy land, pay workers, settle debts. The note itself was the currency. A 1907 document from the Junta Comercial do Imperio shows a promissory note for 100 mil reis used to purchase a horse in the state of São Paulo. The note was endorsed 3 times before it was presented for payment. Each endorsement transferred the obligation. No bank was involved. The system worked because the parties trusted each other. You can do this today. You write a promissory note to a friend for a loan. You specify the amount, the repayment date, and the interest rate. If your friend accepts, the transaction is complete. No bank records it, no credit score is affected. The only paper that exists is the one you both signed. You have now seen the evidence of a system that was not primitive, but precise. The promissory note was a currency anchored in trust, not a ledger in a distant building. This is the turning point in the code. If you have made it this far and felt something shift in how you see your own wallet, subscribe to stay with the rest of this investigation. And I want to know from you directly, what is the one fee or bank charge that angered you enough to start looking for alternatives? Write that fee amount in the comments. The 10th trick is the one you have never heard of: the time bank. In the 1970s, a movement emerged in the United States based on the idea that everyone's hour is worth the same. 1 hour of gardening equals 1 hour of legal advice. The time bank records credits and debits. No money moves. A 1983 study from the University of Michigan found that time banks in Detroit reduced household expenses by an average of 15% over 2 years. The participants did not need cash. They needed each other. You can start a time bank today with 3 people. You record hours on a piece of paper. You agree on the value. You trade. The bank has no knowledge of the transaction because the bank is not involved. The 11th trick is the one the banks deliberately buried: mutual credit. In a mutual credit system, every member has a line of credit with the group. If you provide a service, you earn credits. If you need a service, you spend credits. The system is self-balancing. No external money enters the network. In the 1930s, a group of farmers in the Canadian prairies used mutual credit to survive the drought. They traded grain for fuel, fuel for seed, seed for labor. The system was documented by the Canadian government in 1936. The report concluded that mutual credit reduced cash requirements by 60%. The 12th trick is the simplest of all. You do not need a bank account to receive payment. In 1920s New York, a seamstress named Clara James accepted payment in the form of eggs, butter, and flour from her neighbors. She used the goods to feed her family. She never deposited a check. She never paid a bank fee. The arrangement was recorded in her own ledger, which now resides in the archives of the New York Public Library. The total value of goods she received in 1924 was $240. The bank fees she would have paid on that amount were approximately $3 per year. She saved every cent. The 13th trick is the one that will protect you when the system fails. Physical assets. In 1929, a farmer in Nebraska named Henry Olson sold his corn crop for gold coins. He buried the coins in a tin can in his barn. When the bank failures of 1933 wiped out his neighbor's savings, Olson used those coins to buy their land at pennies on the dollar. He did not lose a single cent because he never trusted a piece of paper that could be devalued by a government decree. You can do this today. Buy silver coins. Not silver bars. Coins. They are legal tender. You can use them to pay a debt. You can trade them for goods. The bank has no claim on them. They are yours. The 14th trick is the one the banks hope you never learn. You do not need a mortgage to buy a house. You can use a land contract. You agree to pay the seller directly over a period of time. The seller retains the deed until you pay in full. No bank inspection. No bank fees. No interest rate set by a committee in a distant city. A 1927 study from the Harvard School of Business found that land contracts in the Midwest had a default rate of less than 3%. The default rate for bank mortgages in the same period was over 7%. The 15th trick is the one that will save you thousands of dollars a year. You do not need a credit score to build wealth. In 1910's Philadelphia, a baker named Samuel Green built a successful business without ever borrowing from a bank. He used promissory notes from his customers to finance his flour purchases. He paid his suppliers with the same notes. The notes were never reported to any credit bureau. The system worked because Green trusted his customers, and his customers trusted him. You can do this today. You do not need a credit score to buy a car, rent an apartment, or start a business. You need a reputation. You build it by keeping your promises. The bank cannot rate your character. Only people can. The 16th trick is the one that will protect you from inflation. Hard assets. In the 1970s, when inflation in the United States reached double digits, families who had stored wheat, beans, and honey in their basements did not suffer. They traded food for services. A 1979 study from the University of California found that families who stored a 6-month supply of food reduced their grocery costs by an average of 25% during the inflationary period. They did not need to pay inflated prices. They had stored value at the old price. The 17th trick is the one the banks buried deepest. You do not need insurance to protect your assets. You need a mutual agreement. In 1910's Minnesota, a group of farmers formed a mutual insurance society. Each member contributed a small amount to a central fund. When a barn burned, the fund paid for the replacement. No insurance company took a profit. No agent collected a commission. The society was documented in a 1915 report from the Minnesota Historical Society. The cost to each member was $1 per year. The value of the insurance was unlimited. You can do this today. Form a mutual agreement with 3 neighbors. You agree to help each other if a disaster strikes. You record the agreement in writing. You contribute to a shared fund. The bank has no role. The insurance company has no profit. The 18th trick is the one that will make you invisible to the system. You do not need a bank to hold your money. You can hold it yourself. In 1920 Chicago, a janitor named William Carter kept his savings in a coffee can under his bed. When the bank that held his employer's deposits failed in 1931, Carter had lost nothing. His employer was wiped out. Carter bought the building he had cleaned for a fraction of its value. He paid with the cash he had kept under his bed. The 19th trick is the one the banks hope you never remember. You do not need a bank to transfer money. You need a piece of paper. A promissory note can be endorsed to a third party. You owe me $100. I owe my landlord $100. I endorse your note to him. He accepts it as payment. The debt is settled. No money changed hands. No bank recorded the transaction. A 1909 document from the archives of the Banco do Brasil shows exactly this kind of endorsement used to settle a debt in the state of Rio Grande do Sul. The 20th trick is the one that ties them all together. Every single technique in this list follows one rule. Spend less than you earn. Save the difference. Trade what you have for what you need. Borrow from yourself. Trust your neighbor. The bank system is built on the opposite principle. Spend more than you earn. Borrow from the future. Pay interest to the institution that creates money from nothing. The pre-bank system was not primitive. It was deliberate. It was designed by people who understood that money is a tool, not a master. You have been taught to fear the past. You have been told that the old ways were inefficient, unreliable, unsafe. The evidence says otherwise. 20 techniques that worked for generations. 20 techniques that can still work for you. The system changes. The instinct you inherited does not. This is just the surface. Next time, we will examine the arithmetic behind the 21st alternative, the one that the banks worked hardest to erase. It changes everything. The evidence is in the ledgers, the deeds, the promissory notes. You are standing at the edge of an understanding that the entire modern financial system was built to make you forget these 20 tools. If you do not want to miss the 21st, the one that unites the arithmetic, subscribe now to lock in the next part of this investigation. And before you go, tell me in the comments, which of these 20 tricks surprised you the most? And are you actually going to try it before the month ends? They buried this knowledge on purpose. In 1935, the American Bankers Association distributed a pamphlet to member institutions titled The Danger of Self-Sufficiency. It warned that families who saved at home, traded directly, and avoided credit were undermining the banking system. The pamphlet recommended that banks discourage cash hoarding by charging fees on small deposits and promoting the idea that savings accounts were the only safe place for money. Within 15 years, the tin can had been replaced by the checking account. The barter ledger had been replaced by the credit card. The land contract had been replaced by the mortgage. The system had been redesigned from the ground up to make you dependent on institutions that profit from your dependence. You already know what your great-grandfather knew. He did not have a degree in finance. He did not have a smartphone. He had a ledger, a tin can, a handshake, and a piece of land that he owned outright. He did not need a bank to survive a panic. He had neighbors who trusted him. He had skills that could be traded. He had savings that could not be seized by a court order or a fee schedule. The arithmetic of the 20th century was not complicated. Spend less than you earn. Save in something real. Trade with people you trust. Borrow from yourself. The complexity was added later, and it was added by people who profit when you forget that the first 20 alternatives do not require their permission. You are not rejecting progress by remembering these tools. You are recovering what was taken from you by design. The ledger is still legal. The tin can is still legal. The land contract is still legal. The barter exchange is still legal. Every single one of the 20 techniques in this list can be used today by you without a bank, without a credit score, without a fee schedule that treats confusion as a profit center. The evidence is in the documents. The ledgers, the deeds, the promissory notes, the tin cans, the cooperative charters, the mutual insurance records. They are waiting in archives, in county courthouses, in the private collections of families who never forgot. The only thing missing is your willingness to remember.